Concept number 11, that is fair forward rate. Till now we were talking about what is a forward rate. We have understood what is a forward rate. A rate which is agreed between you and bank for buying or selling currencies at a future date, specified future date, and the rate is agreed today. Now, we were calling this as a forward rate till now. We would definitely call it as a forward rate, but we would now call it actual forward rate. Why actual forward rate? Actual forward rate because this is a rate actually quoted by a bank for entering into a forward exchange contract. We are trying to assess whether that rate is appropriate or not. So, suppose price of dollar today is rupees 65 and you go and you have to buy dollars after 3 months and bank is quoting rupees 75 per dollar. We also understand that dollar might appreciate against Indian rupee, but over 3 months 65 cannot become 75, correct? This much common sense also anyone can have. But friends, merely having that common sense is not enough. You should also know how to determine whether that forward rate is appropriate or not, and that calls for understanding this concept, that is fair forward rate. Through calculation of fair forward rate, you will get a forward rate which should be the prevailing forward rate. That means that is a fair forward rate. That is the rate which should prevail. If the bank is quoting the actual forward rate close to, very close to the fair forward rate, it is okay. But if the bank is quoting a rate with a substantial difference with the fair forward rate, that means actual forward rate AFR and fair forward rate FFR, they are substantially different, we can challenge the bank and we can bargain with the bank, we can negotiate with the bank, and we can bring down the bank to the fair forward rate as close as possible. And here there is a linking concept of arbitrage which we are going to discuss at little later part. But right now let us begin with question number 20 to understand the application of fair forward rate. Let us read this question. Spot rate $1 equals to rupees 64. Interest rate prevailing in India is 12% and interest rate prevailing in the US is 7%. Determine the fair forward rate for 1 year. So friends, what we have been informed, just 3 things, correct? The spot rate of dollar in terms of rupee, and then interest rate prevailing in India and US. And this information is enough for us to determine the fair forward rate for 1 year. Let us see how to do that, first logically and then by applying formula. So, consider the fact that one side we have US, one side we have India. In US, if there is $1 held by someone, in India the equivalent rupee value is rupees 64. So, what I am trying to tell you is $1 today and rupees 64 in India, both of these are at par value, correct? Because as per the spot rate, $1 is equal to rupees 64. So now imagine that someone in US is holding $1. This party would obviously invest this $1 in US itself at 7%, whereas someone who is holding rupees 64 in India would invest this money in India at 12%. So what would be the maturity value of these respective investments after 1 year? In US, it will become $1.07 after 1 year. In India, the maturity value of this investment will be rupees 71.68 after 1 year. So what we conclude is, after 1 year, $1.07 should be equal to rupees 71.68. Mind it what I just said, $1.07 should be equal to rupees 71.68. I am not saying it will be equal to, I am saying it should be equal to. So we write up that line, after 1 year, $1.07 should be equal to 71.68 rupees. So if $1.07 should be equal to rupees 71.68, what should be value of $1? Value of $1 should be obviously 71.68 divided by 1.07, and that comes to rupees 66.99. So what we conclude is, therefore fair forward rate for 1 year will be $1 equals to rupees 66.99. Let us now present the same thing using a formula. That is how you will be solving questions in examination. So FFR equals to S into 1 plus IL upon 1 plus IF. So what is FFR, what is S, what is IL? Let us write up the description of each variable. FFR stands for fair forward rate. S is the spot rate which is given as rupees 64. IL is the interest rate prevailing locally, that is 12%, and IF is the interest rate prevailing in foreign country, that is 7%. So when we substitute these variables in the formula, what we get is 64 into 1 plus 0.12 divided by 1 plus 0.07, and what you get by calculation is exactly 66.99.